Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I'm the co-host here alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent economic news and statistics, shrinkflation, housing bubbles, home building, starter homes, and so much more. But first, like usual, Stephen, what is going on in the large Thomas household?
Well, if you've been paying attention, all the kids went back to school and we had another one go off to college. So now we're down to only 4 kids in the house. So I feel like an empty nester. And but we're still really busy. With 4 that we have one that's in a long distance running club. We have another one, Zeke, the little one, he's in soccer, and they need a referee for every home game. And since I have been a referee for years, I'm reffing those games. And then we have Athena, who's in flag football. So she has flag football games all the time. So fun. CIF flag football is awesome. And then we have Alana, who's doing cross country. She's a junior in high school. So we're busy. It's busy. We're back to lots of practices and a busy sports schedule in the fall, like so many families. The only difference between me and a lot of other families is I've been doing it with kids for, gosh, the better part of like 20 some plus years. Doesn't ever stop. Anyways, that's what's going on with us. How about you, Brennan? What's going on with Brennan Joseph?
Well, pretty much same old for me, just Arsenal still playing. We're doing pretty well, so that's exciting. And then other than that, I feel like I'm just mentally preparing for the holiday season because I feel like it's just coming at us so fast. And all of a sudden it's going to be Halloween and then Thanksgiving, and then we're going to go right back at the holidays again. So exciting stuff to look forward to. Stephen, what's been happening in the real estate world with supply, demand, and our very own expected market time over the past couple of weeks?
Yeah, this is a confusing time of year for May and us, the reports on housing. And it's only because really we have not we've had these low interest rates that have really come down since the end of July to where they are today. As a matter of fact, today I believe it's at 6.11%, the lowest level, tied for recently hit 6.11. And that's the lowest level since February 2nd of 2023. And if we get below 5.99, it will be the lowest level since August of 2022. So these are, it's really coming down. And you'd think that we would see it in changes in demand. I think out of all the counties, the only one that we could really see a change in demand recently is probably Ventura County. And it's so small, that's hard to gauge. So we're a bit confused because, of course, this demand, we wouldn't ordinarily see it start to come up, which we're starting to see it in purchase application data, but we're not seeing it in our pending sales statistics. But keep in mind, coinciding with this change in lower rates is this change in the real estate industry. So that change in the real estate industry is that makes all the contracts different and negotiation process different. So you're wondering if that's hindering some pending sales activity as well while everybody adjusts. So that'll go away in time and we'll be able to see it because interest rates are really coming down quite a bit. And you can really tell the difference in the monthly payment just from April when it was 7.5% to today when it's very close to 6%. So it's really big. In the meantime, what we're dealing with right now is inventories are continuing to rise as there are more homes coming on the market than last year. And all those extra homes are accumulating on the market. We have not hit our peak, our normal peak for most markets between July and August, yet it continues. This peak is delayed and the inventory continues to rise. And then we're seeing the week to week drops in demand too. It's not like it's falling off the cliff. There were some markets where we saw a big drop in demand within the last couple of weeks, but it's just so hard to gauge with this change in the way that real estate is done right now. So, but nonetheless, we have demand that's coming down, we have inventory that's rising, and that's a recipe for the market continuing to slow in a time where this is the autumn market. Autumn market really began at the very, very end of August. And when the kids go back to school, It's not the fall equinox, which is this coming up Sunday. When you're listening, you're listening to this podcast. Yes, I think it will be. It will be actually this coming up Sunday. So it's just right around the corner. We have the fall equinox, but even though that's the beginning of that fall for the fall season, our fall market for real estate actually already begun because the kids went back to school. So normally we see inventories and demand coming down and the market time remaining the same. So there's really no change in the marketplace. But right now there is a change. It's slowing from week to week to week. So if you're in it for buyers, this is a great time to buy because it's just getting the affordability is getting better, your purchasing power is getting better, and there are more opportunities as the inventory continues to build. So that's kind of what's going on in the marketplace right now.
And what has happened over the past couple of weeks with the economy?
So the big news right now is there wasn't a lot that happened in the prior week. We did have at the very start, we had it was the jobs week, and jobs came in way less than expectations, and unemployment fell down just a tiny little bit. People saw that, oh, that's good news, but it was when you go out all the decimal points, it was such a small little change that it wasn't really much. Really, what this is, what it illustrated is the Fed has to go in September, and we're recording this on the 17th. They're going to be making their announcement on the rate cut tomorrow, the 18th, and whether it be a quarter or a 0.5%. And either way, if they only go a quarter, they're going to come out extra dovish, saying all the different things that they're going to do. If they come out a 0.5%, they won't be as dovish. So let's just say we're trying to front load this, and we'll be going down slowly. So it's one or the other, but they're also it's a big day because they're going to tell us where interest rates are going to be going forward from here. And so every quarter, they actually tell us not only if they're doing rate cuts, but every quarter they tell us where the interest rate cuts are going to be in the future, or interest rate hikes, or if they are at neutral and not changing. So they're not only going to do for the rest of the year, they're also going to be doing 2025. And people are going to be looking at 2025 a lot more closely than they were in June because we don't have a whole heck of a lot of 2024 left. So everybody's going to be looking at everything, trying to read through the tea leaves. So that's really going to move markets. Today we had retail sales that came out, and it was kind of like it was up higher than expected. But when you do what they call a core was actually less than expectations. So it's kind of like this mixed bag. And as a result, nothing really happened. As a matter of fact, I think interest rates for the day went down a tiny little bit, but the 10-year Treasury yield actually went up a little bit. So that meant that spreads actually got better for the day. So it really wasn't these big movements. We've been hovering right around, right below 6.2, above 6.1% with no points across the United States, according to Mortgage News Daily. So that's kind of where everything sits right now. Tomorrow's a huge day. It's going to really rock the market because it's like almost a 50-50 chance between a quarter and a half. We're leaning more towards a quarter because this Fed is old and slow. They should have done it in July. They should have done it a long time before, but they definitely should have done it in July. They missed the opportunity. They know it. That's why they came out saying, yeah, don't worry, we're going to be doing something. And then in August, they met at the Jackson Hole Economic Symposium, and they said, yes, we're for sure doing rate cuts in September. So they should have already gone, and then they would have gone again tomorrow. So if you add that up, that's a 0.5%, quarter and a quarter and a half. And that's my argument, that they need to already be going. Otherwise, they really are jeopardizing the overall economy and the soft landing narrative that everybody's talking about, the longer it takes for them to get closer to the neutral rate. Quarter point, 0.5 point is not gigantic, but it does send messages, and the messaging is going to be very important.
According to CNBC, the bond market yield curve returns to normal from inverted state that had raised recession fears. So what does that mean for our economy going?
Yeah, really, that does not mean that we don't go into recession. the mere fact that we had an inverted yield curve, according to the author of this study and putting this thing together, the inverted yield curve actually is just an indicator. When it flashes that it was inverted, it just means that anytime over, he did say before, it's around 18 months later that you typically see it. But he's been making arguments that it's longer and longer and longer and longer. An inverted yield curve, and then we go into recession 3 years later is not necessarily that any kind of a gauge that you can hang your hat on. And so I'm not convinced that we're going to go into recession. Really, it boils down to what the Fed does more than anything else. So that's where it's at right now. And I don't really see that as an indicator that all bets are off on a recession. I think it's more of what the Fed does. They keep these rates too restrictive. They're going to cause some collateral damage in the economy, and as a result, you're actually going to see rates. You're going to see we could slip towards a recession, and at that point, you definitely would see rates come down at a quicker pace.
So the unemployment rate is on track to surpass 5% by the end of the year, according to economist David Rosenberg. With this sort of prediction being said, is the Fed behind the 8 ball on both inflation and labor?
Well, they are behind the 8 ball as far as they should have already cut. It's like they're waiting for more damage before they cut further. I would agree with that. I don't agree that we're going to get all the way up to 5%. And if we did, you'll see that the Fed gets even more aggressive, and there will be more rate cuts coming at a faster pace. And if that does occur, then yeah, we're into more of a significant rate cutting cycle. But we don't know yet. And there's a lot of guesswork that's out there. That's why there's just these giant debates. You hear everybody from a half point to a quarter point. Some people even still saying, no, I don't even think they should go at all. So they're all over the board. And it's just the same thing with unemployment predictions and things like that. It is so hard to predict anything within this current marketplace because we don't really know how everything's going to unfold, because we really haven't been at this juncture before. This is uncharted waters. So these are the kind of headlines that kind of sell. They're very kind of clicky bait. And when you put that kind of, when you state something like that, because maybe that's how he felt for the day, there's a lot of people that are going to clamor to it because it's counter to what all the arguments have been so far. And a lot of people are, of course, going to clamor to it. Why? Because it's very negative. We're going to get all the way up to 5%. So we'll have to wait and see. I don't necessarily agree with that. We'll find out tomorrow what the Federal Reserve thinks where unemployment will be come the end of the year. And I doubt it's going to align with what David Rosenberg is forecasting.
Now, typically we talk about transactions picking up over time when mortgage rates fall, but could we also see home building pick up as well?
Yeah, because it's a more favorable environment. The builders know that they needed it to be in the fives in order for them to ramp up the number of purchasers out there and create more demand. And they had the ability to get into the fives. And what they did is they just did these giant buy downs of interest rates. So they were able to get there. Now, the residential resale market they haven't been able to do that. And we're knocking on the door of getting into the fives. And that's where a lot of consumers want to be. So they know that. And if we're making our way already to the fives, the builders can already play with it. They can even down the road beat regular market, put more money down, and maybe get some borrowers into the fours, and which will move the needle even further compared to where it's even gone right now. So yeah, I definitely see falling rates as a catalyst to more building, especially in the environment we are right now, where there are so many residential homeowners out there that have these low fixed rates and are not moving. So as a result, they get to create this extra demand because there is not enough supply out there. And that's kind of what will happen as interest rates continue to go down, and you're going to see builder confidence go through the roof the lower rates go.
With prices continually rising to record highs and people paying money for less of a home, is the housing market experiencing shrinkflation, or would that be considered normal inflation?
Yeah, it's kind of like shrinkflation. Yeah, they're getting less of a home, and they're going to have to settle for less of a home. That's really what a lot of borrowers are facing. Those people that have been priced out of the marketplace, and now they're going to come in. They're going to have to recalibrate their expectations of what they want, because for a very, very long time, housing, the square footage was really small. You had most entry level homes post World War II were built 3 bedrooms, 1 bath type of thing. And then it was 1.5. And boy, you got a 2 bath. Boy, it was huge. And we're talking 1,200 square foot homes making their way all the way up to 1,800 square foot homes. If you had a 2,000 square foot home, it was considered gigantic, and not anymore. They've been building bigger and bigger houses, and the idea of McMansion was thrown out there. But the longer we've been stuck with these higher home values, the more that those lower level price range, those single level homes, those properties, they still exist out there. They're just older and dated, but some of them have been redone. There's different things, or people can redo them themselves, and they can get into the marketplace. But what they're able to afford is actually less. So less of a home, because of how high rates have gone, and also throw in how high property values have gone. So because of the mix of the two, what the average person's looking at is a lot smaller of a home that they're able to afford. So for those people that are entering into the marketplace, yes, it definitely feels like shrinkflation. It's kind of like that bag of chips that you purchased, and you open it up, and it looks like it's, matter of fact, the bag shrunk down a little bit, but you open it up and there's only half of it is filled with potato chips. That's that shrinkflation. It's the same thing. If they were out there looking in the marketplace, a few years back, and now they're looking again, they're looking at a much smaller house. So yeah, they feel it. They definitely feel it.
On that note, without saying their name to give them any publicity, someone mentioned that we are currently in the biggest bubble of all time. Can you break down our current housing market on whether we truly are in a bubble, or if there's something else in the mix?
Yeah, I mean, you can kind of say that we're in a housing bubble, because values are so high. It's just affordability is is the real big issue today, and it has to do with, there's only 3 things that can change. It's price, it's interest rates, or it's incomes. We're not going to get this giant boost in incomes. That's not going to happen. And we're also seeing that because so many homeowners don't have to move, and there's not this subset of homeowners out there that get themselves in a pickle and are forced to move. So there's very few forced sellers out there. And if you don't have forced sellers in the marketplace, so you don't have short sales and foreclosures. We just did a housing debrief video on foreclosures and short sales, and an update on it, and just illustrating how it's just not going to materialize. It's unfortunately, anybody that's rooting for that, that's not going to materialize. And that's a catalyst for prices to drop. So you're not going to really get major changes in prices. And so the only thing that you can now root for are interest rates to come down. And it's going to be this new normal. And as a result, it's the shrinkflation that you're talking about. Yeah, rates will come down, but they won't come down enough where everybody's going to be able to afford the median sales price home. It's just there's a lot of people that are going to be staying in their homes, and the people that can purchase, they're just going to be purchasing a little bit less of a home right now. So that's where things are going right now, and that's until in time incomes can catch up, unless values, because demand increases down the road with rates that come down, and we get values that go up even further. Gosh, that's just going to add to the over problem. And by the way, you didn't mention names. I won't mention names either, but that person has been talking about a bubble every single year. And it dates all the way back to, I believe the first one that I can find was back in 2012. So every year has talked about the bubble of all bubbles, and it has a lot to do with demographics and things like that, but they've actually got the overall demographic picture wrong. So unfortunately, and the key to the survival of that demographic picture that they're talking about also is immigration. And legal, illegal, there are more people that are coming into the United States than there will continue to be. And that's how you counter the fact that we are not producing enough babies, is you do that you can do it through legal immigration and get more people in here, because everybody wants to, reside in the United States. Not everybody, but a lot of people, this is where they would love to be, is the United States. So that's why so many people try to come here. And that would be an answer to that. So I just don't see it as a big problem, the giant bubble of all bubbles.
So, according to Fortune, the average American drops $330,000 on rent before becoming a homeowner. So, Stephen, on the topic of affordability, when is the best time to purchase a home?
When you sit down with the lender, you figure out how much you can afford, and then you go look in that area as to what it is, what that comprises of out there in the marketplace right now today. And that is, for a lot of people, unfortunately, it's not going to be a big house at first. It's not going to be a small house. It might be the stepping stones to afford that. And those are townhomes and then patio homes. And just creatively looking, they might have to rent out a room, that type of thing, in order to get into a property. So there are, and they're already renting anyway, so might as well rent out a room to offset that extra mortgage that you have. And so there are solutions that are out there, but only you know if you're able to afford something, and understand that you should look at how much rooms rent for and put that into the whole entire equation, take a look at that and say, now can I afford those type of things? So it's getting creative. It's meeting with some extreme professionals that are out there on the real estate front as well as on the mortgage front, and just and even if you don't go now, that's preparing yourself for what you need to do down the road as your income rises, as circumstances changes, as you get married and you have dual incomes and things like that. That changes the overall picture, but at least you have the right people that you're working with in order to even get into a property. So that's what I would do. Only you will know. And I can't answer that for you. I can just say that when you are able to get in, get in. I just don't see, there's not been major drops in values. Only happened a couple of times. There are different places across the United States that have had different value changes. But if you look at United States, outside of two, and the big giant changes are the Great Recession, which was recently, and the Great Depression. Those are the two times where we could see a major change in values. And people think that it should happen right now. But remember, we don't have the catalyst for that giant drop, because there wasn't unscrupulous lending practices or anything like that, or it was way different if you compare it to the Great Depression. You could do a whole entire study on that Great Depression, but it was a different, whole complete set of different circumstances that caused that whole entire thing. And we're not at that point where there's any kind of house of cards that's about to collapse, unless you listen to that one person that thinks it's the bubble of all bubbles. But if that happens, the whole entire world will flush down the proverbial toilet, and that's not going to happen based upon any trend graphics, trend analytics that we have been looking at. We're looking outside of housing. We're looking everywhere.
A statistic to add to that is, I think I saw it was 40% of all homeowners own their homes free and clear, or like 39.6, which seems pretty surreal to me.
That's a lot. And then the number of people that own their homes at least 50% equity, it's called equity rich. It's huge.
So, as a repeating issue that we've seen for quite some time is the fact that not as many starter homes are being built, since the cost to make them are continually rising. This causes so many potential home buyers to be left out of the market. What is the key factor that could potentially help our state and nation build more affordable housing?
Yeah. This is where we need both sides of the aisle just to get together and hammer this thing out. Yeah, we've got to be, I'll just dream, and hopefully down the road we're a little less divisive. There's not my side, your side. It's just we can all figure things out, reach over both sides of the aisle and figure things out so that we erase the red tape that exists that prevents these builders from building smaller homes, entry-level homes. You could erase a lot of that red tape, a lot of the different hurdles, the amount of money that needs to be spent on every single property just to get it built. A, and B, then you can incentivize builders on top of that to build at the entry level side of things. That's the only way to do it, because you're not going to mandate that builders, which are publicly traded companies, you're not going to mandate that they have to build the entry level stuff. They're private companies. They're not public. So they're going to answer to the bottom line P&L statements so that everybody that's invested in their companies can continue to make a profit and watch those stocks continue to rise. They have to keep that in mind, and they got to reach across both sides of the aisle. Like I said, this is a national problem that affects everybody.
So as we entered this year, you very quickly noticed a trend of many homeowners are coming on the market, signaling a large inventory of homes with similar demand to last year. Months later, since now we are in the middle of September, are you seeing any additional green shoots, as you called it?
Well, you can say that there's a green shoot, and that is more homes on the market. So yes, there's been more homes that have come on the market, but because we've matched this low this low demand against more homes coming on the market, that demand actually has not gone up. As a matter of fact, most of the year spent, it was year over year, interest rates were less than, they were more actually than last year. It was recently that interest rates were less than last year. And it was more than last year for the first half of the year. That ran us through spring, the start of summer. It's like the busiest time of the year. And unfortunately, that's when everybody wants to be in escrow by the time you get to July. And because then you want to close in July or August, and that's during the summertime. A lot of people, families especially, because the kids go back to school and you don't want to really disrupt that. Just saw a neighbor move in a couple weeks ago. School just started. They're right there at the tail end. They hit it. They hit it just in time. But that's the prime time selling season. You have to actually be a pending sale by the time you get to July. These rates didn't really start come down till August, so they're matching up against the slower part of the year. And so we haven't seen this extra lift in demand. And instead, we had a mirror image of last year's demand with this year's demand. Similar pending sales and more homes coming on the market. That was the green shoot of more homeowners coming on the market than the prior year, because last year was the lowest base of all time. So it's easy to beat. Now, the good news is all these extra homes, because they were matched up against the same amount of demand, actually accumulated. And now we have much higher inventories than we did. Across the board, there are more homes on the market, a lot more than what we had last year in every metro pretty much across the United States, and some way more in Florida and Texas and Boise, Idaho. So when you have these extra homes and you're matching it up against lower demand, it's really slowed down the market to the point where buyers in almost every price range have more opportunities or more choices. And we have rates that are down. And so the combination of the two makes it the most buyer-friendly market that we've had since 2022 in a lot of markets. And now recently, within the last couple of weeks, we saw some improvement. So this is the best time for some. It depends upon which metro you're talking about, but we have examples that date back to 2019, back to 2018. I think in Los Angeles County, it was back to 2014 was the last time that we had this favorable of a market for buyers. That's good news if you're a buyer, for Pete's sake, because they have not only been dealing with these higher rates, but they've also had to rush to purchase something, and there's not that many homes to see. So that's an additional green shoot that we have not really elaborated on much, but it's definitely a good point. You made me think there a little bit, Brennan.
All right. Well, thank you everyone again for tuning into another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, the Bay Area, Phoenix, or Las Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a great review. And if you have any questions at all, feel free to post it to any of our social media platforms, or you can even email me info@reportsonhousing.com. We will see you soon and have a fantastic rest of your day. Thank you.
Thank you.